Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing the ANDE stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $47 a share, and they have 34 million shares outstanding. This company operates in trade, renewables, nutrient, and industrial sectors. Their trade segment operates grain elevators, stores commodities, and sells corn, soybeans, wheat, oats, ethanol, and corn oil. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 2021, positive in 2022, then it grew a lot, nearly 800 million in 2023. It's down a little in the trailing 12 months, 670 million. Pretty good margins for this industry. 5% is a lot higher than the other companies we looked at. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty consistent year to year, averaging around 150 million. Revenue is sales for the company, and that's flat from 2021 to the trailing 12 months. It did get high in 2022, 17 billion, but it came way back down. It's similar to a gold company or oil and gas company. You can actually sell more of a commodity and your revenue is lower than last year if the price of the underlying commodity goes down a lot. This company does pay a 1.6% dividend, which only cost them $26 million. So they can easily afford the dividend payment. They can cover it 26 times. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4. That's 2.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.2 billion. We divide that by 34 million shares. And we get a calculated stock price of $66. They're trading at $47. So they're trading at a 29% discount. It's a buy according to the model. What do you think? Do you think it's a buy or sell? Let me know in the comments. There are 14 companies in the same industry as Anderson's, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent 129 million of capex. These are the investments in property, plant, and equipment. A really good debt to equity ratio, a lot better than the median average. Exactly half the companies in this industry pay a dividend, half do not. Their yield is 1.6%, which is higher than the average. They generate 700 million of free cash flow, which is a ton of free cash flow because they're pretty small, only 1.6 billion market cap. Really good price multiples. They're trading at 2.4 times free cash flow, unbelievable. 9 times earnings. They generate 12 billion of revenue and only have a 1.6 billion market cap. And their revenue is still growing. Their 5-year annual revenue growth rate is 16%, higher than the median average. Here's their latest income statement. Revenue went down a lot, from 4 billion to 2.8 billion. Their cost of revenue also declined a lot, so they did have positive gross profit, 175 million. Operating expenses, 116 million, so their pre-tax income is 57 million. 5 million of taxes, net income 52 million, down from 82 million. And they did add some shares, not too much, just maybe 300,000 shares, so they're up to 34 million. So to summarize, I have them trading at a 29% discount. My prediction is 66. They're actually at 47. I ranked them 5 out of 10. Would I buy them? 7 out of 10. The company looks really attractive. Amazing price to free cash flow. So it seems like it's really undervalued. Ratio is 10 out of 10. Not too sure why the stock price is so low, because they're generating a healthy amount of free cash flow and revenue. I gave that financial 7 out of 10. Even though their revenue is pretty much flat, they're doing a great job at growing free cash flow, and that's how you run a business on cash. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.